เนี่ยให้ความสำคัญมากแค่ไหนนะครับหรือมันเป็นเพียงธีมที่เกิดขึ้นในตลาดนะครับแล้วก็มีคำถามหลายคำถามอย่างเช่นใน emerging market เนี่ยนักลงทุนต่างประเทศเขามองemerging market เป็นกลุ่มหรือว่ามอง emerging market แบนเป็นประเทศนะครับแล้วก็มีคำถามอีกหลายคำถามอย่างเช่นว่าแล้วเขาจะรู้ได้ไงว่าใน emerging market แต่ละประเทศนั้นเนี่ยให้ความสำคัญกับ ESG อย่างไรอันนั้นเป็นอะไรที่นักลงทุนสถาบันต่างประเทศให้ความสำคัญนะครับผมคิดว่าหัวข้อท็อปิกในวันนี้มีความสำคัญกับตลาดหลักทรัพย์ไทยนะครับแล้วก็พวกเราทุกคนในวันนี้นะครับมิสเอมิลี่ชิวนะครับเป็น Senior Analyst Research ของ MSCI นะครับแล้วก็ได้คอนแทคกับFETCO มาเป็นเวลานานนะครับแล้วก็จริงๆตั้งใจจะพูดตั้งแต่ปีที่แล้วนะครับวันนี้เธอจะมาให้บรรยายเรื่อง ESG themes นะครับ for Asian equity investor Ladies and gentlemen, please welcome Emily Xu.
Hello everyone, it's really wonderful to be here. Sawasdee krub. I lived in Thailand for a few months in 2010 and have very fond memories, and it's always wonderful to come back and to remember the beauty of the Thai people and the friendliness and the hospitality. So I am a senior analyst with MSCI ESG Research. If you're not aware, I just wanted to help make you aware that MSCI is a global leader in the ESG investment and research field. This is an early stage field globally right now, but it is growing very quickly for our firm and also globally in the market. We have over 200 people in our business unit working on ESG, and of those, over 140 of those people are full-time in-house researchers. Because to understand this issue at such an early stage where it's very new and there aren't clear standards in place of how do we think about these environmental, social and governance issues, it takes that type of investment in order to understand. I lead a team of Asia-Pac based research analysts who every day are researching companies and producing research that our institutional investor clients buy, and they use it to inform their investment decisions. So what I would like to cover today in this presentation is a little bit of background about what is ESG for people who, I'm aware that there are most likely people in the audience that are very new to this topic. So I want to just paint a broad high-level picture about what is this field, what are some of the investment trends in Asia, and what are some of the themes, what are some of the actual ESG issues that are relevant to Asia, and how are some of the global investors that we work with thinking about them and talking about them, and how are we helping them to think about them. So this industry, as I mentioned, is early stage, and it has been growing very quickly over the last 15 years or so, particularly in Europe and in the US. We have seen a lot of growth in those markets, and mainstream investors, as Kun Vuravan said earlier, that CalPERS is a real leader in this area, for example. But there is movement in Asia, and this is being led in, I would say, 3 primary areas that we can see. Governments are obviously at the forefront of thinking about these issues in Asia, and one of the key things that they've done is start to adopt green development economic policies. And that has a trickle-down impact on infrastructure policies, on pollution regulations, and very high-level rules about how they want that economy to develop. The second area where I think we've seen a lot of development is a lot of leadership from the stock exchanges in the region. So, for example, SET is definitely one of those leading examples of educating the market about what is good corporate governance, what is socially responsible corporate behaviour, what is ESG for a company. All of these terms, you know, we have many different terms, but really they're referring to the same type of behaviour. So SET's been a real leader in that area. Singapore has come on board in Q4 last year with a whole raft of principles around comply or explain disclosure. So requiring all of the listed companies in Singapore to explain what they're doing to ensure sustainable development and responsible business activities. And if they don't disclose it, they have to explain why they're not disclosing it. So that puts a lot of pressure on those companies to start to be more open and forthcoming with their strategies. And therefore, where they don't have a strategy, it kind of forces them to adopt a strategy. And we're seeing that discussion happen in Hong Kong as well. In China, this type of environmental disclosure is also mandatory for several categories of companies. And we've seen literally the number of sustainability or CSR reports that come from companies massively increase from only a handful, really, about 5 years ago, to literally a couple of thousand today on mainland China. And yes, the reporting it still can be blunt. Yes, the reporting is maybe still very high level, but the fact that the reporting is happening shows that there's greater awareness and time invested on the part of managers in companies to implement these strategies. It's as the old saying goes, if it's not measured, it doesn't matter. And then the third key development I think that we're seeing is the actual response from companies. We're actually seeing companies do more as reflected in their reports. And so, and then on top of that, that's all on the company side. On top of that, what we're seeing in Asia is governments and stock exchanges start to put money behind ESG investing. They're starting to introduce mandates. They're starting to think about introducing mandates. They're having discussions about good corporate governance. For example, MSCI is assisting the Government Pension Investment Fund of Japan right now with a big project to think about how should they be introducing a stewardship code, which is a type of a good corporate governance code in Japan. We're starting to see funds being seeded, as was mentioned earlier today. And so there is a lot of movement in Asia. But I think one of the key points to realize is that in this field, because it's early and because it's new, relatively to the rest of finance, there isn't one way to do ESG investing. And that's a good thing, because ESG, just as you have different types of investment styles, you might have a quant investment style, you might have a fundamental investment style, you might have active strategies and passive strategies. In the same way in ESG, there isn't one correct way to do it. And what we do at MSCI is we're providing the resources and the information to make it very flexible for investors to integrate it into their existing process. So this information comes from an industry body called the Asian Sustainable and Responsible Investment Association, and they released a report on sustainable investment trends in Asia in 2014. And what they've seen is that, yes, while the actual figure that is invested sustainably or under ESG still remains, relatively small at around 50 billion, the rate of growth shows very sharp trajectory up. 22% CAGR growth in the last 2 years. And what's very interesting about this chart to me is the dark green patch, which is this approach to ESG investing called ESG integration. So ESG integration is one approach. I'll go over it in a minute, but maybe the lighter green patch, which is negative screening, that might be more familiar to a lot of people. The idea that because of your ethics or your values, you want to screen out certain companies that do certain offensive behaviours. For example, in Australia, screening out tobacco manufacturing is a very big thing. People just don't want to support tobacco companies, so they're screening them out regardless of financial performance. In Asia, this type of negative screening has really been pioneered in countries such as Malaysia, for example. They've introduced a lot of Sharia-compliant investment products, and that is essentially a form of negative screening approach, so removing certain business activities. We have the smaller types of approaches are things like sustainability-themed investing, like, for example, a water fund or a clean technology fund. So it's very focused, very narrow. best-in-class screening, so trying to screen out the best companies and only investing in the best companies. That can also be quite narrow. And then a very small amount of money now being managed under this idea of engagement or shareholder action. But the two main ones to really focus on are this negative screening and ESG integration. So negative screening, as I've explained, ESG integration, which is quite dominant in Asia relative to the total, is this idea of integrating environmental, social, and governance concerns across your investment process. And not because of your values, but because you want to deliver long-term shareholder return or long-term return to your members. And so it is not an approach which is in any way disregarding financial performance. It's actually because you want to improve your financial performance that you're integrating these factors. And when I saw this chart, it was very, very interesting and surprising to me, because if you were to look at the US, for example, a similar chart for the US would be much more dominant with a negative screening approach, because that's where the industry has come from. Whereas in Asia, what the investors who are doing this, what they're reporting is that they're actually equally, and the growth in this area is just as fast in the integration approach. And so, as with many types of areas in Asia, the growth trajectory is different. Asia has a tendency to leapfrog in many areas, and I think in the ESG area, leapfrogging over the other development path of other countries is likely to happen as well. Another interesting area is this idea of shareholder engagement. So it does remain small, but most of the investors who are doing ESG investing in Asia say that they do some form of engagement with companies. So they're talking to companies about their concerns about ESG performance or behavior. And in Asia, what we see is that most of these conversations are happening privately. So that you see at the top, direct engagement conducted privately. Again, if you were to look at global investors, or particularly investors in the US who are active in this area, you'd see a lot more weight towards the bottom type of strategies, the shareholders' resolutions, the direct engagement conducted publicly, so going to the media, shareholder activism, these types of approaches, more public approaches. So I think shareholder engagement in Asia is also going to develop with Asian characteristics. It's a very interesting trend to watch. So this is the high-level state of the industry in Asia. Obviously, there's a macro trend. It's moving quickly, and it's moving towards growth. But how do you actually do it? And that's where we come in, and that's these are the conversations that I have with investors all the time about, okay, so you say that you want to do ESG integration, or you say you want to do negative screening, but how are you actually going to do it? And what we actually find is that when we actually talk to a lot of investors, they don't actually have a very clear process for explaining externally to their clients or to the government or to anyone who's asking how they're actually doing ESG. They don't have necessarily a dedicated team. They don't necessarily have a screening, some type of screening process in place. They don't necessarily have due diligence guidelines, or even adopting an ESG investment policy or a responsible investment policy. These are the first steps that need to happen in order to make your process scalable across many different funds, and also to make it transparent, and also to make sure that you're actually doing what you're saying you're doing. And so we're trying to work a lot with our investors to help them make sure that their process is sophisticated and transparent. When you think about environmental, social, and governance issues, and I like this chart because it shows that normally when in the investment community we focus on the red circle, the corporate performance circle, and around the corporate performance there's a lot of environmental and social resources that corporate performance relies on. But there's lots of overlap. It's a little bit fuzzy. Some of them are more important than others at different points in time. And so it's no wonder that it's quite difficult as an investor when we're all so busy and we're all being pulled in many directions by many different interests and demands. It's very easy to say, oh, ESG, that's for tomorrow because I don't have time, because it's really, really complicated and I don't have the skills or the expertise to be able to distinguish the relevance of carbon regulation compared to product safety recalls, compared to chemicals, compared to board diversity. There's many different areas involved. But the reason why we think it's important is because these different resources around corporate performance can become material, and they can become material very suddenly. So for example, we saw that last year in Korea. We saw that there was a major data breach in that market. Over half of the country, the whole population of the country had their personal banking records compromised. There were many concerted hacking attempts on mobile phone companies and communications companies. And this suddenly turned into a crisis. Now, the background to this is obviously that Korea is the most online and wired and interconnected economy in Asia. So that kind of creates the conditions for this issue to arise. There's more and more services being offered online. The growth of all of the strategic growth strategy of all the companies is an online strategy. So that is the macro trend, economic trend. And that creates, over time, the potential for this type of ESG issue to arise, a privacy breach, a data breach. And then the fallout from that is, that's the ESG trigger, is some type of event. It can happen very quickly and have a material impact on the company. The fallout is then that the Financial Services Commission issues new guidelines. There's investigations happening about fines. Companies potentially get suspended from business due to these incidents, or they have to rearrange their departments. In some cases, when we see different incidents arise, heads roll. There are sackings of people, or people their license to trade is suspended, for example. And then those actual impacts can be material. That can actually impact sales. It can impact on your ability to access markets. And so, even though these ESG issues can be difficult to define, they are important. And forward-thinking investors are investing the time into understanding these issues and mapping their exposures to these issues so that they can be ahead of the curve. And the time to do that really is now, because as we saw, the amount of funds under management under ESG strategies is growing. This trend is only going to become more important. And to get ahead, similar to what Chris was saying earlier, though, there's an opportunity here to get ahead rather than to be playing catch up. So what MSCI is doing is providing a range of research tools and products to help investors with their different types of strategies, negative screening and the ESG integration. And this is a slide with too much text on it. I'm not going to just bore you by describing all of our products in detail. I'd rather provide some examples of what those products do. But broadly, on the yellow side of the slide, we have ratings products, which are a deep dive look at a particular company's forward-looking exposure to environmental, social and governance risks and opportunities and the quality of their management. So this is a very financially oriented approach to ESG. This is an approach that says, I don't want to have to sacrifice my returns, but I want to actually understand all of these areas of value around corporate performance so that I can better manage my risks. It's just responsible investment management. On the green side, we have more of the response to the values-oriented investors, or the investors who it doesn't really matter to them whether they're not interested in looking at performance. They just want to screen out negative activities, or they want to screen out companies that pose a reputational risk to them. So we're increasingly seeing asset owners not want to be seen to be involved with companies that have an ongoing record of human rights violations, pollution incidents, corruption at the board level. They don't want to be seen to be supporting those types of companies, because that creates pressure on them too. So that type of concern is a distinct concern that we're responding to with a different set of research tools. So as you can see, the reason why we have 140 researchers is because there's many different types of research that needs to be produced, and the same information packaged in different ways. So often investors ask me, but how do you actually do the research? Because isn't disclosure an issue in Asia? Yes, disclosure is an issue in Asia. Disclosure is an issue everywhere, actually, because companies themselves don't know what it means to be environmentally aware. A lot of companies think that, oh, if we report turning off the light bulbs, or we report reducing corporate travel, that makes us, you know, an environmentally friendly company. Well, really, it depends on what type of company you are. If you're a chemicals manufacturer, it's very different to being an insurance company or a bank, for example. So these different factors play a different role. So the company disclosure can be an issue, but essentially our research and our ratings process is now independent of what the companies are saying. Yes, we always take the company disclosure into account. We give every company that we rate, the large and mid-cap companies that we rate, an opportunity to look at what we've collected on them and to verify, correct, just be more forthcoming with missing data points. But we also have our own data, because we've been doing this for decades now. We're able to develop our own data sets that are approximations that are fairly good data sets, fairly accurate ways of thinking about the companies. So for example, carbon emissions. A lot of companies don't disclose this, but because we've got many, many years of collecting this data, we understand what a chemicals company of this size, approximately their range of carbon emissions should be about that, because we know from all of the other chemicals companies that we've been watching for the last 10 years. And so we're able to use those data sets to inform the rating process. We have a very rules-driven rules-driven approach to the rating, and then out of that comes these types of products. So this is our ESG ratings for Southeast Asian markets with a focus on Thailand. And AAA on the left-hand side is a very strong performance on ESG, and CCC is a very poor performance. So what AAA means is that this company has a very strong environmental, social, and governance standards and risk strategies and accountability inside the company. And they also have lower exposure to some of those issues, such as oil spills or carbon taxes, etc. And CCC means companies that are very highly exposed and have no apparent management, or very, very poor management, and quite possibly a very bad track record. And so what we can see with Thailand, actually, is that of the key Southeast Asian markets, Thailand is a real leader in this area. And this curve has actually moved to the right in the last 2 years since we've been researching Thai companies. Sorry, to the left. My hand went to the left. Directionally challenged, yes. It moved to the left, which is good. So the top, and you can see even South Korea. I mean, South Korea has also historically had strong performance, but as a proportion of their total market, the Thailand line is higher among the higher ratings. So that's really good news for Thai companies, and I think what this shows is that all of the efforts that the GPF, the SET have invested in the good corporate governance training, in the CSR Institute, is paying off over time. You know, these are efforts that take 2, 3, 4 years to pay off, but it does pay off, and this is a great story, I think, for Thai companies and Thai institutions to be talking about, particularly in terms of the CLMV strategy that Chris was suggesting earlier. So all of our research pops out in terms of a company level rating, and broadly those are what the ratings mean, and we'll go into an example in a minute. We're also looking at controversies, so that is another area of research. We're looking at examples where companies have contravened some type of global norm. So there's been some type of event. Chris mentioned earlier the CNN news cycle. And so we have a whole team of people basically following the CNN news cycle. But Chris also mentioned that it's important not to just take everything at face value. Not everything is equally as important. So you know, one bank manager in a branch office may be committing a little bit of fraud with a check or blank checks or something is not the same level of magnitude of impact on the stakeholders, the people or the environment, as Gulf of Mexico oil spill. You know, they're obviously completely different leagues of issue or controversy. And so our team is researching all of the companies in our coverage on these incidents and classifying how severe they are, minor, moderate, and severe. So you can see with most of these key markets in Asia, you've got majority of these issues are kind of small issues, minor issues, not issues that are going to grab media attention for more than a couple of days. Whereas the moderate and the severe controversies are ones that are going to really grab attention for months, possibly a couple of years. And these are the types of reputational risks that certain asset owners just don't want to have any exposure to. And certain asset managers also don't want to have exposure to that because their asset owners ask them, why are you associated with this bad company, essentially. So, I thought that would be, that's an interesting, chart to see. You see quite a lot of moderate controversies in Malaysia compared to the other markets. And so an example of where a controversy, where we bring together the controversy research and the ratings research, is with Yanzhou Coal. So this is also an important trend to be thinking about for Asian companies, because Asian companies are increasingly making investments, purchasing other companies, particularly in developed markets, say in Europe, for example. We're seeing that a lot with China. Chinese companies investing in Europe. This is an example of a Chinese company that invested in an asset in Australia. We're seeing Asian companies increasingly expand regionally and operate in other operating contexts that they might not be so familiar with. And what we identified with Yanzhou Coal is that there was a real gap in their health and safety risk management practices. And what we identified is that of the metals and mining companies that you could compare them to on a global basis, they are very highly exposed to this risk. So you see on the right-hand side of this chart, you've got the dark blue bubbles right on the extreme right. That represents companies that are very highly exposed to health and safety incidents becoming material. So more likely to have, because of the nature of their mining, because it might be more underground versus overground mining, because of the countries where they're operating. They tend to have lax health and safety standards or more health and safety problems historically, and we know this from data sets. Yanzhou Coal was very highly exposed. And on the y-axis, what we see is the quality of the management. So the companies at the bottom of the y-axis, very poor management. Either there's no health and safety risk committee, there's no reporting to the board on these issues, they might not even be reporting any fatality rate, or if they do report it, it might be high. There's no evidence of training. They're not including contractors within their safety policies or their safety trainings. And higher on the y-axis shows a very high level of management. So essentially, if you're thinking about this from an investability point of view, you want to invest in the companies that have low exposure to these risks and a very high quality of management, because they're essentially the companies that are less likely to have a problem in this area, come up quickly. And from an investability point of view, you probably want to avoid the companies, or you want to underweight the companies that have very high risk exposure and very poor quality of management. So we picked this up in December 2013, that Yanzhou Coal is among this group of companies with very high exposure and only moderate, not very strong risk management. And then, 4 months later, we see a massive problem in Australia. Their mine in Australia collapsed, killing 2 people. And that might not be a lot of people compared to some of the mining fatality rates we see in China, but in Australia, that's a really, really big issue. That is front page news. That is something that causes the shutdown of a mine. That causes government inquiries. It causes investigations that take a year. So all of your management around that Australian mine is now distracted for a whole year, having to respond to these government inquiries. There'll be fines imposed. And what actually happened with this particular mine is because it actually represented 12% of that company's forward-looking guidance for 2014, earnings guidance for 2014. So that's a big chunk of your forward-looking revenue suspended or potentially gone. And they had to actually move 25 people into another mine site to keep them occupied. They had to make other people redundant. There's a lot of fallout from just this one incident. So this is how our ratings would help to try and anticipate where those risks are in an investment portfolio. And this might be used by a fund manager who is trying to look at companies one by one, but it can also be integrated into a higher level, more passive strategy as well. So for example, because we have a very strong index business and ESG research is part of our company, we're able to collaborate and work together and meet investor demand for ESG index products. So what these products are doing is essentially taking our investment universes, the MSCI All Country World Index, for example, and we also have a collaboration with Barclays on the fixed income side. We take the companies on those indexes in those universes. We've got the research for all of them, and then you can filter them through that research to create many different types of indexes. So, for example, you can have a sustainability index, which is looking at highly rated companies that also have that are not don't have problems with the controversies, big problems with controversies. You can look at the SRI indexes, which are looking at different types of value factors. So are they involved in tobacco? Are they involved in weapons